Hi, good morning, everyone. I'm David Sasson. I'm the head of counterparty credit risk management at ANZ. So welcome to this first session on the second day. Today we'll have like a panel discussion around data first approach to credit risk management. So first, let me introduce our speakers. We have Yves Tombal, who's the Chief Risk Officer at MUFG in Singapore, for MUFG Bank Singapore. He's been working he has a 15 years international experience in derivative trading and risk management. Previously, he was head of market risk department for Asia. And prior to joining MUFG, he worked as an interest rates option trader at Standard Chartered Bank in London, Dubai, and New York. We also have Prasoon Agarwal. Prasoon is co-head of credit risk for Asia Pacific at Goldman Sachs. He has spent the past 15 years in credit risk managing risk across various business trips, including global markets, investing and lending, and asset management. And last but not least, we have Saj Patel, who's the head of pricing, valuation, and reference data for Asia Pacific at IHS Markit. Sage has been with IHS for 8 years, starting with a legacy Markit entity. And prior to joining Markit, Sage was responsible for pricing and valuation at Fitch Solution. And he also spent a portion of his career at key tier one investment banks, starting at Salomon Brothers into Citi Global Markets, Bank of America, and RBC. So thanks to the speakers for joining us today. We'll start with the first question. Managing credit risk during the pandemic was highly challenging. As with every global crisis, there are opportunities to learn. So first question will be around what are the lessons learned from the crisis? How do you analyze the response of financial markets and financial institutions during the crisis in support of the global economy? Yves, we'll start with you.
Sure. Thank you, David. Well, I think what we saw during this crisis, first of all, is that while all the regulatory tools that have been built after the crisis, while being highly effective, were again not needed because the government again stepped in quite aggressively to make sure that the overall economy would be supported and that we wouldn't be going through any kind of major default that we saw during the first financial crisis 10 years ago. What I think is important to see indeed is that those mechanisms held their stake. They were quite effective to shore up liquidity across the economy. But overall, I think what we now need to discuss is whether the amount of regulatory capital and asset that has been set aside to support any kind of crisis is becoming a bit counterintuitive and counter economical, because we end up having banks loading up reserves in times of difficulty, while at the same time we have governments telling financial institutions that they need to be there for their client, that they need to support the economy. So there seems to be some areas of enhancement and review, but I think overall what is quite positive, and that's what I'd like to finish this answer on for the first question, is that it worked. We have passed through this crisis without any major default or any major issue in the market, and that overall is a positive sign.
Thanks a lot, Yves. Prasoon, do you agree with Yves that it worked, but the regulation may be a little bit too conservative?
Sure, thanks, David. What I'd say is, look, if we look back previous crises like 2008, it started more as a financial crisis and then seeped into real economy. I think this time around, it's been a little bit other way around, where it started with the health crisis, seeping into economic crisis, industrial, and then obviously it has a knock-on effect on financial markets, banks, etc. Now, I agree with Yves, where the response has been swift. A lot of tools which were built previously has been deployed very, very quickly in order to buffer any real impact on the economy. We'll continue to see that, I think, because we're not completely out of the woods in terms of economic growth, in terms of where the pandemic is going, etc. In my mind, the real challenge from here is how do we come out of it in a way where the growth is not very lopsided in certain sectors versus others, and in turn, it does not have sort of material impact from a banking and financial markets point of view. We will see some impact, which will likely be lingering on. But in my mind, that's the real challenge on how we continue this and come out of it now.
Thank you very much, Prasoon. Saj, what is your view on that?
Thanks a lot, and it's great to be with you guys. I think, needless to say, I think the events of the last 15 months or so have been unprecedented. I'll take a slightly different angle. I mean, again, with Prasoon and Yu's comments are spot on. I think what's happened, and again from a service provider's perspective, is clearly the volatility that has taken place in the markets has had an impact into how risk is managed and how it's perceived and viewed. We've seen areas where you've seen entry into new markets. You've seen where margin has taken a big place within this space. No doubts that the impact to people, what's happened there. And then with all of this is with the backdrop where regulators have continued to press ahead with some of the direction that they laid out, whether it be from capital allocation rules, accounting rules, etc. So in terms of how the market behaved, I think, and I think one of the panelists mentioned that we did it, we did well. And I think there's many lessons that I'm sure that we will touch on further down in the panel that we can take away and improve on. But needless to say, I think in terms of the essence of this panel, where data has played a significant part in helping support those decisions, those conversations, and to give that seamless, well, it felt like a seamless way out of this or those very volatile months that we saw. So I think in summary, I think we've done very well. And I think to Prasoon's point is that there is a long way to go. But again, with the backdrop that there is a hard press continuation to implementation of the varying regulatory requirements that are taking place specifically for the Asia Pacific region.
Yeah, thanks a lot, Saj. And actually, to follow up on that, and maybe to look at a bit more in detail on the impact of the crisis in terms of credit risk management. So the features of this crisis were very unique. The impact on credit worthiness differed widely by sector or subsector. Historical data were not relevant. We didn't have any previous reference on the credit impact of a nationwide lockdowns. So how did the crisis impacted the credit management and credit decision making? And has it led to a quicker move to the adoption of a real-time data and analytics into the credit decision process? Prasoon, what's your view on that?
Yeah, thanks, David. I think one of the key features has been that the focus on tail risk management has been brought to forefront a lot more versus I think what we were seeing maybe a few years back. And like you said, these are unprecedented times, not something that anyone could have really predicted with precision. And there will be more events in future, maybe of different nature, of different magnitude, etc. So in my mind, the key lesson and the way for banks to go forward is how we use all the data and build tools which helps us in accurate or more precise stress predictive modeling, improve the frequency of availability of those stresses, improve the sophistication of that, how we can manipulate the stresses, because every time a crisis might be different and we see and expect a different impact. And I think that's the key to improving the credit risk decision making as an outcome of this event, in my mind. And as we go along and improve that sophistication, we get better at portfolio risk management, analytics, but also at the individual counterparty level. And I think that's where banks and us are spending a lot of time on using the data in that sense, which is less focused on, I would say, making the right prediction, but preparing the portfolio to weather the storms when you do run into unexpected tail risks.
Thanks, Prasoon. Yves?
So, I think I agree with you, Prasoon, that indeed we could maybe not, foresee how this pandemic would pan out. But I think what it actually showed is the incredible difficulty of a risk manager or anyone in charge of stress testing or looking forward to convince a governing body of taking action early on the back of the result of a long shot stress test. Already in 2015, President Obama, Bill Gates, were openly talking about the risk of a pandemic. And yet not a single government took serious actions to prevent it, or at least to be ready for it. So it just shows again the limitation, or maybe an area of enhancement, on how stress testing should be analyzed, especially the tail risk of stress testing, where we know that the impact is massive, but the likelihood is very, very low. How do we deal with that? How do we incorporate the cost of that into our daily management framework, knowing that it will probably only be an extra cost because the likelihood is so low that you may never have to use those extra measures, and it's extremely unpopular to implement, and that's what we saw, and we probably see again, because we're not right now seeing governments massively changing their policy. Will they continue to shore up protective gear for the next crisis? It's hard to see. And it's the same thing for banking institutions. You talked about data and you talked about credit analysis. I think you're absolutely right that we need a more dynamic, a more resilient management of the volatility of a client's overall health or exposures. We need to be able to in a much more quicker way assess its finance worthiness. But it's extremely difficult to implement, especially for large financial institutions, because you need to have a real-time access with your client, and you need your client, therefore, to use a platform for their daily cash flow management that you provide, so that you can have access to that information in real time. I think this is where challenger banks, digital banks, will have an increasingly large competitive advantage if indeed the large corporates are interested and keen to move to that kind of platforms. So we'll have to see if indeed it picks up. But for the retail market, I think clearly this is a growing opportunity and market.
Thank you very much, Yves. Yeah, and actually, like to what you just mentioned, like a real-time access to data. So there's a significant amount of data that are still held in disparate database within the banks, and information is not always consistent and comparable. But at the same time, we've seen that regulator and executive management that we are looking for in the moment real-time data to monitor and manage the crisis. So are risk functions capable to access the data and this kind of level of granular data in order to report on the spot to the board or to the regulators in this kind of highly volatile environment? Sej, what's your view on that?
Yeah, look, I think the question around data has always been with us. Obviously very exaggerated in recent years, or the year and a half. Data in itself, and again, I think this is a very obvious statement, is a fundamental aspect of how any of the functions operate. You've raised the point where the role of a risk manager in today's world is incredibly difficult. It's always been difficult in my eyes, because again, one of the key inputs into there is data. Now, data in itself is we ban the word around quite frequently. Data this, data that, repository this, databases and etc. But ultimately, it's the integrity of the information, to the point that Yves and Prasoon mentioned, the capabilities and the tools that are needed to be able to create these scenarios, to test and stress against varying scenarios, potential areas that they see of challenge, is something now that is really reliant on how good and how clean and the integrity of the data is. So we're moving to a world now where data is accessible, but we also work within a region where data is limited. If we look at activity in our markets, they're very limited to some extent. Secondary market activity is generally muted. So the tools that a risk manager needs to manage counterparty risk are kind of different, right, from the more established markets or the more liquid markets. Being able to perceive, create proxying, create sector-based views, enabling you to stress is something that is definitely real. Now you're seeing the emergence of local markets, and again, potentially driven by the retail space, where the appetite for the chase for yield is coming through. I think Yves mentioned where you're seeing these digital platforms coming through. The digitization of our markets now are becoming very, very, fundamental to how we operate. So data in itself plays that significant role. Now, whether real-time is something that is there, and again, real-time markets are there in Asia, and how do you calibrate and leverage on them and use them is a different story. So service providers like ourselves are in that space to really provide those additional metrics, tools, data sets that can help support the conversation, that the risk manager needs to have with its respective board, exec, compliance, legal, etc. So these are the areas that I think is becoming more and more so. Just to finish off on that point, one of the significant trends that's come through from this pandemic thus far is really about how do we better use information. I've got a pool of data. Any institution has a pool of data. Is there a way that you can calibrate that and create that additional transparency? Independence is a clear factor here as well. That enables, the decision making that Yves and Prasoon touched on.
Thank you very much, Sej. Prasoon, do you agree? Do you have access to the data that you need? And do you see like a more limitation in the Asia market given to due to a lower amount of available data?
Well, I completely echo what Sej mentioned around the challenges related to ownership of data, integrity of data, and to some extent also regional or market differences. That certainly has been, I think, a challenge. A couple of things I'd probably just add on to it from my perspective is, one is we are also kind of getting into a space where, while we have limited data on number of issues, at times you also see a lot of conflicting data and information. And that's the challenge, that with the amount of information we deal with, how do you sift through on what you should be taking into account and what you should not? And to some extent, that could also lead to an information overload and make that decision making even more challenging. The other aspect of this is, if you look at it from a board or regulator's point of view, I think they're very interested in getting an aggregate picture of risk. Whereas, generally speaking, across risk stripes, that in itself may not be easy. A credit risk versus a liquidity risk versus a market risk, we could be using different matrix, even with the same set of information. But we need to come to a point where we are able to aggregate risk across risk stripes as well, because that's what I think our boards and regulators are increasingly more interested in terms of the impact of a single event or a risk event.
Thank you very much, Prasoon. Maybe to come back on a point that Yves mentioned at the beginning of the discussion regarding regulatory requirements. So we've seen an increase in capital and liquidity buffer in the wake of the GFC, and that probably left banks in good position to endure the crisis, or at least much better, in a much better position compared to where they were back in 2008. Still, the regulatory expectation for managing credit and liquidity risk continue to increase. So what is the next big regulatory challenge, and how does it impact the credit decision-making process? Yves, do you want to expand on that?
Sure. Sure. Let's split it into different areas. I think from a liquidity risk perspective, we've seen that the LCR and SFR regulations have worked well. Even though we haven't had the chance of really testing these regulations in the current crisis, because again, the market was flooded with liquidity, so we never really came to a point where banks, at the beginning at least of the crisis, had to really dig into those HQLA assets and see whether the capacity to transform these assets into cash would be working into a real crisis environment. So we didn't really get a chance to do that, but nevertheless, I think the pressure on the government was a lot less than what it was during the 2008 crisis. So for that, I think it worked quite well. My biggest concern right now on the credit risk side is IFRS 9 and the potential combination impact of IFRS 9 with other regulation, which is just increasing the burden of setting aside sufficient reserves against your exposure. And with IFRS 9 during this crisis, we thought that the volatility of the reserve that you have to set aside against your exposure is a lot larger than what it was before IFRS 9. And it has a very counter-cyclical impact on the economy, where when your clients are suffering the most, where even from a financial credit risk, from a counterparty credit risk exposure, when financial institutions are going through such crisis, that's where you are required by the rule to increase your provisions at the highest. And even the governments were surprised by this effect. That has a profound counter-cyclical impact on the economy, where you're expecting financial institutions to support the economy, but at the same time, they are being asked to put even more reserves on the side. And these reserves, again, are not put against an actual default. It's just to shore up against a change in a rating due to the way the rule works, or simply because you've had such a downgrade that now you'll have to look at the overall term structure of the exposure, and that dramatically increases your required amount to be set aside that exposure. So I think it would be good. I don't know if they will, but I think it would be good to look into the way the crisis as in how those regulations have worked through the crisis, and whether we can find a way that is more supportive of the economy, especially during hard times. Thank you.
Thank you, Yves. Saj, how do you see this regulatory pressure, and what is the next big challenge in the industry?
Yeah, I mean, I think there's not really that much to add to what Yves has said, except that, if we were to just think about a couple of major or should I say changes that are going to take place to our marketplace, the IBOR transitional phase is something that's going to be significant. But again, if I were to just touch on, the accounting rules that Yves just touched on, exactly, I mean, completely spot on. But also remember this, adoption of, the IFRS rules in Asia are being localized. Localized means that there's localized data that's needed, information that's needed. To some of the points that you've just touched on, whether it be from a liquidity standpoint, a measuring of risk, all of these now are being adopted with the headline as IFRS 9, but then you've got localized views. I mean, Japan's a good example with the J-GAAP rules that have just come through. What is that requirement there? It's specific to that domestic market. So there again, the importance of data to service the risk managers is fundamental here. Giving that ability to understand the directional view of a broader market and not just a singular asset class coverage is something that's fairly significant and is going to play out even more so in the coming months and years.
Thank you, Saj. And actually, maybe if we can jump directly to maintaining this data integrity, it's crucial for a number of reasons. And as you said, there's an increased regulatory scrutiny in navigating data compliance is becoming a bigger challenge. So how does increased regulatory scrutiny is impacting data governance, and how can you help from a data provider perspective?
I mean, data integrity and data scrutiny has always been in our language. This is something that any service provider, data provider should be doing full stop, whether there's a crisis or not, because the decisions and the data has a material impact to the downstream, to the risk managers, to the trading teams, to the valuation groups, et cetera. So, governance of data is paramount. I mean, anyone who says that that's only becoming relevant now, well, I won't comment on that, but quite frankly, it's something that has always been in play. I think where it's changing is evolution. I mean, you look at we just touched on some of the specific reg that's coming through that's having a requirement and an impact to how data is behaving and how it's scrutinized. We overlay that with, like I mentioned earlier, the challenges that we have in a local market. Where you do, access to information is difficult, and then it's a case of how do you validate that data before you even allow customers to leverage it in whatever capacity is needed. So governance around data is fundamental to data, full stop. Usage of data, being able to deliver the data to our customers in a real-time basis or in a live as you can get, depending on the market, is again another thing that's paramount. For you as risk managers to make your decisions, and the pressures that you are under, for all your downstream reporting is significant, and that's where whether you have the right analytics in place, the right models in place, the key component is having the right data and the right governance around it, ensuring the data is of the quality that's expected and has already gone through a heavily scrutinized eye, then it's, I think, that combination does go some way to provide, the tools that the industry is definitely looking for, whether it be regulatory driven, whether it be compliance driven, whether it be valuation driven. And again, the list is endless, right?
Thank you very much, Saj. Going back, return on equity in banking remains globally under pressure due to what we just discussed, additional capital requirements, but also fines and lagging cost efficiency. All of this puts sustained pressure on risk management, as banks are finding it increasingly difficult to mitigate risk through incremental improvement in the risk management process. So how can data and digitalization of credit process help the bank expand despite those pressure? Prasoon, what's your view on that?
Sure. So look, I think there is certainly an opportunity where this can be used in a way which makes our risk management process more scalable, builds more operating leverage as we expand in terms of either volumes of business or complexity of business, etc. So there's no doubt there is an opportunity where data can help with that, and the systems can help with that. I think the challenge really is that all needs upfront and constant investment to get to that sophistication and maintain that on an ongoing basis. And that's the real sort of trade-off and challenge for banks, that to get to that point, you do need to come with some upfront investment, which ultimately then plays into the same your cost and margins and capital efficiency, etc. So I don't think there's an easy sort of answer to it, but it's really for individual institutions to sort of navigate that challenge. But I think there is certainly an opportunity where this can be used in a more favorable manner.
Thank you, Prasoon. Yves, do you agree? Do you see an opportunity there for banks to navigate this digital and data challenge?
Sure. I mean, I think one good way to look at that is to look at the new digital banking model, because technically this is a window into the future. It shows you what you can today achieve if you don't have any legacy constraints, system constraints, and scalability constraints. And what you see there is a completely different credit risk model. They no longer rely on discretionary data, financial statement. They rely on live cash flow information. They run AI algorithm through the live cash flow information and can predict the evolution of the credit worthiness of a client live. So that cost-wise, it's extremely efficient. You can remove probably 3/4 of your credit officers because the system is actually running the algorithm on the actual cash flow information from the client. And for the client, it's also an extremely enjoyable experience because they are offered a full cash flow and financial data management platform for them to manage their daily operations. So that kind of seamless integration of risk management between the client and the service provider and the bank is what I believe the way forward. Now, question is whether larger institutions will be able to integrate such model in the future. I think clearly some of the solutions are in that model, and if we have to do more, be more efficient without extra cost, because we know that the next 10 years are not going to be about increasing costs in the risk function and in the compliance function. It's the other way around. We got our golden years, the last 10 years. This is gone now. So now it's about reducing the cost of credit and compliance. So the only way to do that is through more efficient algorithm-based data analysis. And I think one of the key is to integrate your client in that journey by saying, if you do your part by using my systems, that gives me access to real life data that is that I can use to make a better judgment, and that can give us a better relationship without increasing the cost on either side.
Thank you, Yves. Prasoon, anything you wanted to add?
No, nothing more from my side. I mean, maybe, I don't know, Sage, curious and interested if you had sort of comments around that.
Yeah, I think just one thing, just to, again, slightly on a different tone, but exactly along the same lines. Governance of data is also taking a very significant play in, bringing new products to market. Again, when we talk about the rise of digital, the rise of that sort of retail space, the hunt for yield, all of those buzzwords, there's clearly an impact it has in that decision-making process. Investment committees, each of your institutions will have, new product committee type processes that do genuinely really look at, how does data, how does it help within that process? One thing that's always, again, another thing that's always been in play is the want for best practices. While we talk about the shift in the behavior of customers, the best practice adoption has been in full flow for a few years now. And that's really been driven by, number one, the regulatory regime that's taking place pan-Asia. But secondly, it's the investor appetite, the investor requirements for governance, integrity, understanding the landscape. And again, something that plays into the risk manager's hands. You guys are there to provide that additional color that where, as and when investors are needing for them to access the market. So that's all I just wanted to add there, David.
Thank you very much, Saj. We only have like a couple of minutes left, but maybe want to touch about the recent collapse of a large fund, which has shown the importance of robust collateral management. Can data help achieving visibility over collateral, predicting margin call, reduce cost, and raise capital efficiency for collateral management? Sorry, Yves, what's your view?
I mean, it's certainly. I mean, during the crisis, we saw clearly as well that the importance of having real-time collateral data management. Well, I think this is not new. We've always, and IHS Markit is one of the best provider in this space. So I think Sage will have a much more informed response to give here. But definitely, it just showed again the importance of trusting the data that collateral data providers provide, and ensuring that you are indeed revamping and looking at your data in a more accurate way as you run these parameters into your systems. But I think, yeah, just to keep it short, I think it's that is not new. That is something we've been striving to incorporate for quite some years, and the crisis just shown again the importance of it.
Thank you very much, Yves. Prasun, quickly.
Yeah, I would just say, look, I mean, ultimately, the data analytics and risk information is the first part of the risk management, and then there is a process of decision making and executing that decision. Clearly, we want to minimize the time and make it as efficient as possible on the first step, so that, as risk managers, we can spend more time taking that decision, especially when things get more complex, large. And in a lot of these cases, it's really the speed of response that matters, and I think that's how we leverage this.
Agree. Thank you, Prasun. Sage, do you want to
Yeah,
close on this point?
Yeah, just very quickly. I think again, the guys have articulated it very, very clearly and very well. The additional point, and again, I think this is something that Prasun touched on, is having access to a wide range of data. Not just a singular point. And having the tools. So really collapsing data sets, looking at the behavior. Whether it's AI driven. Whether it's behavioral, there's many facets that you can take to it, and having a piece of data that can enable the risk managers, and again, very simply, make better calls.
Thank you very much, Sage. So I think we just ran out of time, so I just want to thank the speakers, Prasun, Yves, Sage. Thank you very much for your contribution. That was a great discussion. Steve, back to you.